You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mike Yahoo. Hey, what's up, Market Moose? Mike from The Moose on the Loose. I hope you're doing well today. All right, so here we are. As of August 18, so the last Monday, the TSX was up by 13.6%. So I tracked the XIU, so that's the TSX 60, the 60 biggest companies in Canada. And it's almost up 14%, including Dividend, year to date. 2024 was up 20.7%. So last year, 21% up. The year before, 2023, up almost 12%. So we got 12%, 21%. We're now getting close to 14% this year. We are long time due for a bear market, right? I mean, that's kind of crazy, but this is what it is, right? So a lot of investors are thinking, well, I'm not too sure about investing right now because it's been like 3 years with double-digit increases. That's just crazy, and we are long time due for at least a correction, which is roughly like 10% market down, or bear market 20% from peak value. So I thought today about let's take a look at what happened over the past few bear markets. And then I'm going to tell you a little bit more about why you are so scared or concerned about investing right now and a solution for that. And I'm not talking about like staying invested or investing one third. I have like something else for you towards the end of this show today. So what happened in the past bear market? So we had one in 2022, not too far ago, right? Not too long ago. And ironically, if you just look at the year, so from January 1st of 2022 to January 1st of 2023, XIU was only down 6.4%. So yes, during that time, the market was down more than that, but overall, 12 months, minus 6. Followed by, as I told you, 2023, that was up almost 12%. So let's go back a little bit longer now. The other bear market that we had was in 2018. So 2018 market was down 7.8% from January 1st, 2018 to January 1st, 2019. And guess what? In 2019, the market was up almost 22%. And I'm just talking about the Canadian market here. I'm not even talking about the US market because the S&P 500 was doing a lot better in both years. So then you're going to tell me about Mike, you forgot about 2020. I'm like, yeah, okay. I kind of forgot about 2020 because we had a very, very quick market depression, like minus like 35%, right? From what I can remember. But the year ended in positive territory. So it ended at plus 5%. So there's absolutely nothing here to be worried about in 2020. Yes, COVID going to end the humanity, but still the market went up by 5% during that year. So before I tell you what to do like next with your portfolio or with your cash, I want to tell you a story. A story that happened several years ago. I was a private banker, 2014. The market was on fire. The year before in 2013, it was up 13%. Over the past 2 years was up 22%. And many investors were concerned. They were wary of like what's going to happen next, right? I mean, keep in mind, 2014, that's only 5 years after the market crash. So 5-6 years, whatever. So 2008, 2009, beginning of 2009, biggest financial crisis in the world, end of capitalism, everything's going to crumble. And then 5 years later, the market is on fire. And now investors are just thinking everything is overvalued. It's going to crash and there's no way out. And I was attending a conference by the president of my branch, not my branch, but my department. So private banking, 1859 back then. And the president was like talking about the market. And then he said, well, what if this is only the beginning? What if, why do you always assume that it's going to get worse, right? Maybe it's going to get even better. And that kind of shocked me back then because I thought, well, dude, I mean, it's been 5 years. It's pretty solid. Probably that we're long time due for a bear market or something like that. It's going to come up like one day or another because the market keeps going up like double digit, which is quite concerning after a while, right? So we kind of talk about overvaluation all the time. This is exactly what's happening right now. But then he came with his high level of conviction telling me, Mike, you're wrong. Like it's going to go, like it could go up like easily. There are like a lot of good reason as well to think that the market is going to continue to go up. And I mean, the rest of the story between 2014 and 2025, I mean, that was a pretty good ride. So for those who were stayed invested then, I mean, they made a lot of money. And of course, I told you that zillions of times. Stay invested. If you have cash right now, just invest over the 9 months. Have like a plan with like specific dates. 1/3, 1/3, 1/3. It's gonna go up. It's gonna go well. I mean, and it's all good. But here's the thing: you probably don't want to buy right now. You probably want to sit on the sideline, even though I offer you like that kind of solution. Why? Because the reason we don't buy at one point is we lack of confidence. We don't trust the market and we are afraid of losing money. And that is stronger than any very solid plan to invest money every month, every 3 months, or every year, whatever, right? So why don't you have strong confidence right now? Like, what's the problem, right? Why are you so afraid of the stock market crashing? I mean, I just reviewed the last bear markets and the real impact was like -6, -8. And then even 2020, it was +5% over 12 months. Not 12 years, 12 months. Nothing, right? So here's the thing, probably that your strategy is not clear, right? I've met so many investors. They are looking back. They are trying to pick the best strategy that did well over the past 3 years, 5 years, whatever. They look and they're just like, yeah, Mike, why don't you just invest it like this? I mean, over the past 5 years. And I'm like, yeah, well, kind of easy to play Monday morning quarterback, right? So you're not going to win the Super Bowl playing Monday morning quarterback either, though. Yes, you know what happened last weekend, but it's not going to tell you what's going to happen next next weekend. So when you look back, you won't guarantee. You want to pick something that worked in the past, assuming it's going to work in the future, but it's not how it works, right? We all know that. So yes, it gives you some indicators, but not necessarily giving you that confidence. So you need to start looking forward. You need to build a strong strategy. And a strong strategy could be everything, literally. I mean, it starts with defining your goals. Like, which kind of portfolio do you want? Which kind of investment you want? Like, you want to have something like ends off, you go with ETFs, like an all-in-one ETF. You do your investor's profile, and then you don't have to do anything. Everything is being handled for you. So that's great. If you want income instead, well, you're going to go for GICs, for bonds, for dividend yield. Maybe you're going to go for covered calls. If you go for leverage covered calls and all that stuff, thinking that you're going to generate like 30% income forever, that is going to be sustainable, I'm just going to tell you to be very careful about that and really understand how it works. But that's not the purpose of today's show anyways. If you want a little return, well, then you can go for a lot of ETFs that are just going to broadly follow an index, for example, like buying XIU that tracks the S&P 500, the S&P TSX 60, or you can go to like the S&P 500 with VFV, or are there any other ETFs that are like just tracking broad index? You could go for dividend growth investing, like my strategy that is focused on selecting specific stocks with in a basket of like companies showing great metrics. You can go for momentum. You have like all the choices in the world, and all those strategies are valid. It's all good. The point is like knowing exactly how you want to invest, and then you have to ask yourself, which kind of drop are you willing to take? I know it's like super classic financial advisor stuff, investor profile, but that's what it is. I mean, if you're worried about a crash coming, well, if you're 100% equity, that crash will hurt your portfolio -20 to -30%. So that's huge. You invest 100 grand, you're going to maybe lose $30,000. That's kind of crazy, but that's how you should be looking at it. If you're like 80% stocks, 20% fixed income, well, then your drop is going to be closer to minus 20 in the worst case scenario. If you want to go for a balanced approach, like 60-40, 50-50, 40-60, like those are like all the balanced stuff, well, then you're going to go around minus 10 for most crises. Sometimes you can go down to minus 15. That could happen. This is what happened in 2008. Most balanced funds were down like 15%. So now you need to know which kind of drop you're willing to take based on the goal that you want to invest in. If you want to have an example of like which kind of strategy I have, for example, and why, like the reasoning behind that, I provide you this in the Dividend Income for Life guide. So you can download it for free at moosemarkets.com/income. So you get the Dividend Income for Life guide. You get all the theory behind why I have this investment strategy, why it works, why I'm 100% confident. But just keep in mind, that's my strategy. It doesn't have to be yours, but it gives you a pretty solid example of how to build your investment strategy. So moosemarkets.com/income. So I'm going to end quickly this show with why am I so confident? So here's the first thing. I don't give value to my investment in terms of price performance, especially not short term. So if a stock or my portfolio is down 15%, I'm not saying I'm a bad investor. I'm just like, yeah, I have investment thesis that proves me the opposite. I have a firm belief in those companies because I know them and I know that they're going to continue to do well over time. I also know that my strategy has worked in the past, so it gives me more confidence, going to go do well in the future. Not necessarily going to beat all the other strategies. That's not the point, because you don't know which is going to be the best strategy. You just have to know if you are comfortable with that. And finally, don't tell me that you don't have time to recover. I mean, worst case scenario is going to take you 4 years to recover. Like that happened in the 2008 financial crisis, in the tech bubble as well. That was 4 years to recover. If you don't have 4 years to recover, my friend, well, don't consider investing in the stock market altogether. Because I mean, you should be investing in the stock market only if you are able to go for a full cycle, which is usually between 5 to 10 years, right? So don't think it's going to be the end of the stock market, because that means that you won't be able to buy food at a grocery store. So if you're afraid of that, well, you should be afraid of a lot of things. That doesn't necessarily include investment either. In the end, humans adapt and companies are ran by humans. So I am fully confident that whatever the next problem is going to happen, we're going to find a solution and it's going to be great. So that's why I always stay invested, and I hope that you will too. So again, if you want a good example of how to build your investment strategy, you can download the Dividend Income for Life guide at moosemarkets.com/income. And we are going to talk again on Friday for Retirement Friday. So until then, don't forget to, of course, stay invested. Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy this show and do your due diligence after it.